Budget 2024-25 comes at a particularly challenging time for Australia's economy, with significant risks to the inflation outlook, a weak consumer, but also a need to significantly invest in capacity across our economy over the next couple of years. Joining me to discuss the key challenges and also the implications of the budget for Australia's economy is Westpac's Chief Economist, Luci Ellis. Luci, welcome.
Thanks, Elliot. It's great to be here.
Lovely to have you here. Luci, to start with, the labour market and population growth are very strong. Commodity prices and inflation are elevated, but we have seen a very weak consumer. Per capita spending continue to decline. How have these different forces shaped both the starting point and also the forecast for the budget?
Well, Elliot, the data are mixed, as you said. High inflation has helped boost revenue through bracket creep. High commodity prices continue to surprise government revenue on the upside, but we do have a weak consumer and we do have a lot of spending needs. So while the starting point is now better because of those upside surprises, and with a conservative assumption on commodity prices baked again into the budget, we could see another upside surprise in the final result for 2024-25. What we're seeing in the announcement tonight is, of course, a swing from a surplus in the current year to a deficit in 2024-25.
Thinking about the government's kind of key policy initiatives in this budget, I mean, cost of living is a major topic throughout the budget, and obviously a big concern for households out there. How is the government looking to try and really sort of dampen down or bring down inflation quickly in the economy?
Well, cost of living is a huge issue for so many households right across the income spectrum. The household sector's been squeezed by the rising cost of living, but also by a rising tax take as well as rising interest rates. And so they're getting it from every direction. What the government's decided to do is structure a lot of its cost of living support in ways that will reduce measured inflation. They've expanded the support on electricity bills, they've expanded rent assistance, they're making medicines cheaper, and they're involved in a range of other support measures such as reducing HECS debt. And so it doesn't surprise us that the government is forecasting that inflation will get to around 3% by the end of the year. Our own forecasts, which incorporated our best estimates of what the government was going to announce, were not that different from that. They're a little higher, but very much in the same range. The Reserve Bank, of course, doesn't incorporate government measures into their forecast until they're announced. So their own forecast does look a lot higher. And now that we've seen these policy responses introduced, their inflation forecast for headline CPI at least will have to come down. Now, it might seem like a bit of a trick to reduce measured inflation in this way, but it does reduce people's actual experienced cost of living. It will probably reduce people's inflation expectations, or at least help them remain more anchored. And with lower measured inflation in 2024, that means that future indexation of some administered prices will actually be a bit lower. So there's a second round effect in the subsequent year.
Okay, so obviously we had those impacts coming through, but I suppose in addition, this budget also includes the stage 3 tax cuts. There's a commitment basically to provide the quite significant increases that are being looked at in terms of wages for critical sectors such as early childhood education and aged care as well. From those kind of forces, are there still potential reasons why we should be concerned about medium-term inflation expectations and inflation itself?
Well, the stage 3 tax cuts were already in everyone's forecasts, and they were almost necessary in order to bring household consumption back into the black. Household consumption per capita has actually been falling for the last 18 months in a way that we're not seeing in peer economies. So without the stage 3 tax cuts, we would have still seen a lot more bracket creep and a squeeze on household spending. In fact, the stage 3 tax cuts really only take back about 18 months worth of bracket creep. We're still seeing a relatively high share of household income going to tax even after the stage 3 tax cuts. Where I think we do need to pay more attention is in some of the new spending decisions that have been announced tonight. In a world where we do have a tight economy, where there's not a lot of spare capacity, that does add a little bit of inflation risk to the outlook, but we do have to put it in perspective that the economy isn't growing quickly at all. It's growing quite slowly. The pickup in growth through this year is relatively moderate. Policy is tight. Monetary policy is tight. Fiscal policy has been tight. So we do need to put that in perspective.
So the other big kind of theme of this budget is investment, more in the medium to long term, and thinking about our capacity as a nation. Of the kind of key initiatives in this budget, how do you think they are likely to, I guess, shape our nation going forward if we think to the sort of medium to long term?
I think there's a range of areas where the government's policy priorities are showing signs through this budget. The critical minerals initiatives, the efforts to encourage more investment in green infrastructure and green energy, even things like the determination that universities need to provide more student housing if they want to attract more foreign students. These are all about creating sustainability in the infrastructure profile for the kind of growth the government wants to have.
Yeah, just on that kind of, I guess, green economy or the economy tomorrow, last year or two we've seen a lot of discussion around the US, so thinking about the way in which their government is seeking to, I guess, boost the economy and boost confidence in the economy, and that's had implications for growth expectations, but also for the US dollar. Thinking about kind of what the Australian government is now looking to do in these kind of areas, is there, I guess, an opportunity here for, I guess, expectations around growth to be supported, and equally, just thinking about the Australian dollar as well, could potentially the Australian dollar be supported over the next year or so by some of these initiatives?
I think it's really important to have a sense of scale of these things. Despite a really tight economy, strong growth, very tight labour market, the US federal government is running a 6% of GDP deficit. It is putting so much stimulus into the economy, as well as encouraging so much investment in the green transition through its subsidies. The scale of this, even relative to the size of their own larger economy, is massive compared with what the Australian government is proposing to do. I mean, we have been running a surplus. This is the second consecutive surplus. They're saying today that they expect to swing into deficit to the tune of 1% of GDP. That's nothing compared to 6% of GDP. And as we know, the budget announcements are always predicated on a relatively conservative view of commodity prices and of bond yields, and so it's entirely plausible that you end up with yet another pleasant surprise when it comes to the final outcome for the budget. So it seems hard to credit that you'd have anywhere near the scale of impact on growth or indeed on the exchange rate. But of course, that also means you just don't have the kind of upside risk to monetary policy and to bond yields that we're seeing in the United States.
So it's a nice little segue into, I guess, a key question coming out of this budget is, are there implications to the RBA and to the cash rate profile going forward?
My view is that although they will indeed have to revise down their headline inflation forecast, it probably doesn't move their view of trimmed mean or trend inflation that much. I think they'll be looking at the balance between lower reported inflation and therefore less risk that inflation expectations become de-anchored, and at the same time there is a bit more government spending. So I think in the broader scheme of things, this budget is mostly neutral for what the RBA might seek to do.
Well, thank you for joining us tonight. Lots of very interesting and themes I think we'll be talking about quite in detail for quite a number of years to come, actually, I think. To our viewers out there, thank you for joining us as well. Can I encourage you to head along to Westpac IQ to see all the full content of our analysis of the budget. They'll all be up there shortly. And also, as next week, we'll have our, I guess, the household view in terms of the budget with the next Westpac Consumer Sentiment Survey to be released next week as well. Well, thanks for your time. We'll see you next time.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.